Hello guys, today we'll be going over accounts February-March 2022, paper 1. This is a multiple choice paper and we have a time limit of 1 hour. So let's get started. Which actions are taken in respect of the totals of a 3-column cash book at the end of an accounting period? So we know that the 3-column cash book consists of a cash column, a bank column, and a discount column. And we need to figure out whether the cash, bank, and discount columns are balanced or total. So we know that the two of these columns, cash and bank columns, are always balanced. And the third remaining column, discount column, is always totaled. And this is given in option B. So that's our answer. Which item is an example of a capital expenditure? So we know that capital expenditure are those expenses that are non-recurring in nature. So they do not occur multiple times or more than one time. The first option is cost of repairs to an office building. So the cost of repairs is something that can occur frequently. So this is not a non-recurring expense, which means that this is revenue expenditure. So this cannot be our answer. The second one we have is cost of repainting business name on a delivery van. Again, the cost of repainting business name can be of recurring nature, which means that this is also a revenue expenditure. So this cannot be our answer as well. The third one we have is a legal cost paid to purchase an office building. So when we purchase an office building, that's not something that's going to occur frequently. So this is a non-recurring expense. And we're talking about the legal costs paid to purchase an office building. So if this event is only likely to occur one time, then the legal cost paid for that event is also going to occur only once, which means that this is an example of capital expenditure. So option C is our correct answer. Let's just look at option D as well. Option D is legal costs to collect outstanding receivables. So outstanding receivables is something that's going to recur in nature, which means that this is revenue expenditure. So this cannot be our answer. On 1st July 2021, Tim bought a delivery van for 10,000, so that's the cost for the delivery van, and he paid an additional 900 to have racks fitted inside. So this is an example of capital expenditure, which means that this is going to occur only once. And since this expense is of capital nature, we need to include it in the total cost for the delivery van. All right, and the next is 800 for a year's insurance. We know that insurance is something that's going to occur every year. So that's recurring expense, which means that this is of revenue nature. So this is only included in the overhead section of the income statement. This is not going to be included while calculating the cost for the delivery van. Next, Tim provides for depreciation at the rate of 10% per annum, and a full year's depreciation is charged in the year of acquisition. All right, what was the total for expenses recorded in Tim's income statement in respect of the van for the year ended 30 September 2021? All right, we're talking about the expenses. So expenses is going to include the depreciation and the insurance. And what we know is that a full year's depreciation is being charged. So let's just calculate the depreciation. In order to do so, we need to figure out the cost of the delivery vehicle first. So that's going to be the original cost of 10,000 plus the additional cost to have racks fitted inside. So that's 900, which gives us a total cost of 10,900. All right, next we'll figure out the depreciation. So depreciation charge is going to be 10% of the cost. So that's just 10,900 into 10%, which gives us a depreciation of 1,090. All right, so we have the depreciation as 1,090. Next, we're going to calculate the insurance expense. All right, so the insurance is paid on 1st July 2021, and we're only recording the expenses till 30 September 2021. So the months between the 1st July 2021 and 30 September 2021 are 3 months. So we only have to include the insurance expense for the 3 months. But this 800 is for a year's insurance, which means that the 800 is paid for 12 months. Now we just need to calculate what would be the insurance expense for 3 months. So it is very easy if you calculate it using the unitary method. So that's just going to be 800 into 3 by 12, which gives us the insurance cost for this year at 200. And we're going to add that to the total expenses. So this gives a total expense of 1290, which is given in option A. That's going to be our answer. A business has a year end of 31st December and it purchased a non-current asset on 1st January 2020 for 100,000. And then the asset was depreciated using the reducing balance method at 20% per annum, and it was sold for 40,000 on 1st January 2022. So the year that has passed in between 1st January 2020 and 1st January 2022 is 2020 and 2021. So in order to figure out the loss on disposal, we need to figure out the net book value of the non-current asset on 1st January 2022. And in order to do so, we need to figure out the depreciation charges for the year 2020 and 2021. So let's just do that first. All right, for the first year, we are given the depreciation method as reducing balance method. So in order to calculate the depreciation using reducing balance method, we need to multiply the rate with the net book value. But since we're talking about first year, there's not going to be any accumulated depreciation, which means that the net book value is just going to be equal to the cost of the non-current asset, which is 100,000. So that's just going to be 100,000 into the depreciation rate of 20%. So that gives us the depreciation of 20,000 for the first year. All right, for the second year, the accumulated depreciation is going to be 20,000. So in order to figure out the net book value, we need to subtract this accumulated depreciation from the cost. So that's just going to be 100,000 minus 20,000 into rate of 20%. So the total depreciation for the second year is going to be 16,000. All right, then the accumulated depreciation. So the accumulated depreciation is just the total depreciation. That's going to be the depreciation for year 1 and depreciation for year 2, which is 20,000 plus 16,000. So this gives us a total of 36,000. All right, now let's just figure out the net book value. So net book value is going to be the difference between the cost and the accumulated depreciation. So that's 100,000 minus 36,000, which gives the net book value at 64,000. And we're already given that we need to calculate the loss. And also we can see that the sales value is less than the net book value. And the loss on disposal is just going to be the difference between the sales value and the net book value. So that's 64,000 minus 40,000, which gives the difference of 24,000. So that's going to be our answer, which is given in option B. What is entered in the sales ledger control account? The first one given is cash sales. So we know that only credit sales are included in the sales ledger control account. The second one is increase in provision for doubtful debts. So we don't record anything relating to the provision for doubtful debts in the sales ledger control account. So that's not going to be included as well. And the third one is returns inwards. So return inwards is something that's going to occur during sales, right? So we need to include this in the sales ledger control account as well. So the correct answer is going to be option D. A trial balance included a suspense account and the bank balance of 28,412 had been mistakenly entered as an overdraft and placed on the credit side as 28,142. And there also had been an addition error and the debit side of the trial balance had been undercast by 450. So which entry in the suspense account will correct these items? So I'm just going to create the trial balance. So this is going to be debit side and this is going to be the credit side. And I'm going to rectify all of these errors. So the first one is that the bank balance had been mistakenly placed on the credit side as 28,142. So in order to eliminate this, I'm going to have to place the same value on the debit side as well. So that's going to be 28,142. Now, in order to enter the correct bank balance of 28,412, this value needs to be included in the debit side as well. So that's going to be 28,412. And the next we're given is that the trial balance had been undercast by 450 on the debit side, which means that this 450 should be included on the debit side. That's going to be 450. All right, then the total balance on the debit side is going to be 57,004. So this value is on the debit side, which means that the suspense account will have the value of 57,004 on the credit side. So our correct answer is given in option C. Which statement is correct? The first one is that the balance on the irrecoverable debts account is carried down to the next accounting period. That's incorrect because the balance on the irrecoverable debt is actually treated as an expense, which seems to be given in our option B. So that's going to be the correct one. Let's just look at option C and D as well. The balance on the provision for doubtful debts account is calculated before the deduction of irrecoverable debts. That's incorrect. The balance on the provision for doubtful debts is actually calculated after the deduction of irrecoverable debts. And the fourth one is that the balance on the provision for doubtful debts account is not included in the trial balance. That's incorrect as well. This balance is actually included in the trial balance. So our correct answer is going to be option B. The following information is available for a business at 31st December 2021, where given the general expenses in arrears, advance, arrears, and advance at the opening date and the closing dates. And the total amount paid during the year ended 31st December 2021 is 11,500. We need to figure out the amount to be included in the income statement for general expenses for the year ended 31st December 2021, which means that the opening and the closing balances for arrears and advance need to be adjusted in this total amount paid during the year. Alright, let's just start from general expenses in arrears on 1st January. So this means that this is the outstanding expense of last year. So last year's expense should not be included as the current year's expense. So we need to deduct the value of 420. The second one given is the general expenses in advance, 1st January. So this is given in advance, which means that this expense of 240 corresponds to the year ended 31st December 2021. So this needs to be included. So I'm just going to add it. The third one is general expenses in arrears, 31st December. This means that this is an outstanding expense of 720 corresponding to the year ended 31st December 2021, which means that this value should be included. So I'm just going to add it. And the last one is general expenses in advance. So advance means that this expense of 120 is for the next year. So this is not an expense for the current year ending 31st December 2021, which means that I need to deduct this value. So that's minus 120. Now the total amount to be included in the income statement is going to be 11,920, which is given in our option D. When would the year-end value of inventory need to be adjusted? The first one is when inventory has not been yet paid for. So when the inventory has not been paid for, that's going to be just credit purchase, right? And credit purchases need not to be adjusted. So that's incorrect. The second one is that when selling price has fallen below cost. So if the selling price is actually lower than the cost price, then we need to adjust the year-end value of inventory. That's true. And the third one is when the owner has recorded taking goods for his own use during the year. So if the owner had not recorded, then this would have been something that would have needed to be adjusted. But the owner has already recorded this, meaning that we do not need to adjust it. So this is just going to be our answer, C. A business had a draft profit for the year end of 250,000 and the following errors were then discovered. The first one is that the depreciation charged was 25,000 but the figure should have been 40,000, and the second one is that the closing inventory for the period was undervalued by 10,000. So we need to figure out the correct profit. So let's just adjust the depreciation first. So the depreciation charge was 25,000, but we actually need to include 40,000. So I'm just going to add the depreciation figure back to the draft profit because we know that depreciation is actually deducted. So if the 25,000 was deducted before and I'm adding the 25,000 back now, so that's going to adjust the value, but I should also include the correct balance for the depreciation, which is 40,000. So depreciation is deducted, so that's going to be minus 40,000. And then for the closing inventory, the value was undervalued. So I need to add this value of 10,000 to the closing inventory. And we know that in order to figure out the draft profit, the closing inventory is always added, which means that this value of 10,000 needs to be added as well. So this gives us the total correct profit of 245,000, which is given in option B. Now, a capital account for a sole trader contained 3 entries in addition to the opening and closing balances. What did these entries represent? Okay, the first option is capital introduced on the debit side. So that's incorrect. So whenever capital is introduced, that's actually recorded on the credit side. So option A is incorrect. The second one also includes capital introduced on the debit side. That's incorrect as well. The third one includes drawings and loss for the year. So drawings and loss for the year are both something that's going to reduce the balance on the capital account. And whenever there's something that's going to reduce the balance, that's going to be recorded on the debit side, which means that this is correct. Now let's move on to the credit side. We have capital introduced. Like I said before, whenever capital is introduced, that's going to be recorded on the credit side. So that's correct as well, meaning option C is our correct answer. So let's just look at option D as well. It has profit for the year on the debit side. And as I've said before, only those things that actually reduce the balance on the capital account are recorded on the debit side. But profit for the year is something that's going to increase the value. So that's incorrect. So option D is incorrect. The correct answer is going to be option C. The year end of a business is 31st December 2021. On 5 January 2022, inventory was counted and valued at cost 30,000. We need to figure out the value of inventory, which should be included in the financial statements at 31st December 2021. So all the events that took place after 31st December 2021 should be eliminated from this cost. All right, let's look at the events. The first one is that goods purchased and received after the year end costing 1,500 had been included in the valuation. So this is something that's occurred after 31st December 2021, which means that this value should not have been recorded. So I'm just going to subtract the 1,500. It included goods returned by a customer after the year end. So this is also something that's occurred after 31st December 2021, and they had a selling price of 900, which included a markup of 25% during the year. So we know that inventory valuation records the cost, not the selling price. So I'm going to have to figure out the cost price for this. All right, that's just going to be sales value equals to cost price plus markup of cost price. So that's 0.25 cost price. So we know the sales value to be 900. And if we take the cost price common, that's going to be 1.25. So the cost price is just going to be 900 divided by 1.25, which gives the value for cost price at 720. So this should not be included, meaning this value should also be deducted. So that's minus 720. All right, the last one is that some goods included in the inventory costing 500 were damaged. So damaged goods should always be reduced. So I'm going to reduce the 500. But they can be sold for 300 after repairs costing 100. All right, so they can be sold for 300. But we need to deduct any repair cost. So that's going to be 100. All right, so the total value of inventory that should be included is going to be 30,000 minus 1,500 minus 720 minus 500 plus 300 minus 100, which gives a total of 27,480, which is given in option A. A sole trader provided the following information for the year ended 31st December, where given the increment in non-current assets, current liabilities, capital, and drawings for the year. So we need to figure out the profit for the year. In order to do so, I'm just going to make up the statement of financial position, but just including the increased amount. All right, let's just look at the assets first. So assets is going to be non-current assets of 25,000 and the current assets of 10,000, which gives the total assets of 35,000. Next, we have the capital and liabilities. This includes the capital that is of 20,000. It also includes the current liabilities of 12,500. And we should also include the drawings. But drawings are deducted. So that's going to be a negative 13,000. And there's going to be the profit. And we know that the assets and capital and liabilities should have equal amount. So the total is also going to be 35,000. Now the profit acts as a balancing figure. And in order to figure out this value, I just need to deduct these three values from the total amount. So that's going to be 35,000 minus 20,000 minus 12,500 plus 13,000, which gives us the profit of 15,500, which is given in option C. Which rule does not apply in the absence of a partnership agreement? The first one is interest on partner's loan is charged at 6% per annum. This is incorrect. The interest is actually charged at 5%. The second one is that no interest on capital is charged. That's true. The third one is that no salaries are paid to partners. That's true as well. And the last one is that the profits and losses are shared equally between the partners. That's true as well. So our correct answer is going to be option A. P and Q are in partnership, sharing profits and losses equally. And on 1st January 2021, the partnership had net assets of 410,000. At that date, R was admitted into the business on the following terms. So net assets was to be revalued to 480,000. So that's profit on revaluation of 70,000. Alright, next, the goodwill was valued at 50,000 but will not be retained in the books of accounts. And the last one is that profits and losses will now be shared at P 40%, Q 40%, and R 20%. So we need to figure out the change in Q's capital immediately after R's admission. So in order to figure out the change in Q's capital, we can just drop the capital account for Q, but we're going to omit the opening balance. Alright, so this is the debit side, that's the credit side. So the first one we have is profit on revaluation. And we know that profit is something that's going to increase the balance on the capital account. So we need to record it on the credit side. But this profit is divided into two equal halves for the partners P and Q. So that's going to be 35,000 each. So we need to record this 35,000 on the credit side. Alright, next we have the goodwill, which was valued at 50,000. Now for goodwill, we need to record it on both sides, debit and credit. So we're going to record it on the credit side first. And on the credit side, this is always recorded on the old profit sharing ratio. So 50,000 is going to be divided into two equal halves. So that's 50,000 by 2, which is 25,000. So this amount should be recorded on the credit side. Now for the debit side, we need to record the goodwill at the new ratio. So that's going to be 50,000 into 40%, because that's the ratio for Q. So that's 0.40, which is going to be 20,000. So this needs to be recorded on the debit side. Now we need to figure out the change, which is going to act as the balancing figure over here. So that's going to be X. Alright, let's figure out the total for the credit side. That's 35,000 plus 25,000, which is 60,000. Which must be true for the debit side as well. And the balancing figure, which means the change in Q's capital, is going to be the difference between 60,000 and 20,000, which is 40,000. And since this value is on the debit side, this represents an increase in the capital balance. Now the increase by 40,000 is given in our option D. X and Y are in partnership, sharing residual profits and losses equally, and then partners are charged 2% interest on their drawings. Y is entitled to a salary of 10,000. We're given the partners' drawings, we're also given the profit for the year, and we need to figure out how much did each partner receive as a share of the residual profits. So in order to figure out the share of residual profits, we're going to have to figure out profit after appropriation. We're going to start from the profit for the year, which is 52,000. Alright, let's just look at the interest on drawings first. So interest on drawings are always added to the profit for the year. So let's figure out the interest on drawings for X. That's going to be 12,000 into 2%, which is 240. For Y, that's going to be 8,000 into 2%, which is going to be 160. So we need to add these two amounts. So that's going to be plus 240 plus 160. Next, we have the salary. Salary is always deducted. So that's going to be a negative 10,000. Now this will give us the profit after appropriation of 42,400. Now this value is needed to be divided among two partners X and Y equally. So that's going to be 42,400 divided by 2, which gives us the share of residual profits at 21,200, which is given in option D. Which statements are correct? The first one is dividends can be paid out of a general reserve. So general reserve is something that's created from the amount in the retained earnings, and we know that dividends is something that's going to be paid from the profits earned, and we know that retained earnings include the profit earned, which means that the general reserve is also going to include the profits. Hence, the dividends can be paid out of general reserve. So first statement is correct. Second one we have is rights issues can be made from the share premium account. That's incorrect. Actually, bonus issues can be made from the share premium account. The third one is that the general reserve can be created from retained earnings. As I said before, the amount in general reserve is always included from the retained earnings. So that's true as well. So the correct answer is option B. A limited company had the following balances on 1st January 2021. We're given the revaluation reserve and we're given the retained earnings. We're also given the profit for the year, and revaluation reserve 20,000 was created 2 years ago from a revaluation of the property. The same property was revalued with a revaluation loss. So that's loss, which means that 35,000 needs to be deducted. We're also given an interim dividend 40,000 which was paid, and we're given a final dividend which was proposed. Now we need to figure out the value of retained earnings at 31st December 2021. Alright, so I'm just going to create a schedule for the retained earnings. So we have the opening balance of 142,000. Let's look at the revaluation loss first. So we already have 20,000 in the revaluation reserve, which means that out of this loss of 35,000, 20,000 can be covered from the revaluation loss. But there's the remaining 15,000. So the remaining 15,000 is something that's going to be covered by the retained earnings. And since this is a loss, this needs to be deducted from the retained earnings. So that's going to be 15,000 negative. Alright, next we have an interim dividend paid. So this is something that's going to reduce the balance on the retained earnings, which means that the 40,000 needs to be deducted as well. And the final one we have is a final dividend, which was only proposed, which means that this value of 55,000 was not yet paid. So that's not going to be included in the schedule for the retained earnings. And we're also given the profit for the year of 105,000. So the profit for the year is always added to the retained earnings. So that's going to be 105,000. Alright, so the closing balance is going to be 142,000 minus 15,000 minus 40,000 plus 105,000, which gives us the total of 192,000, which is given in our option D. The bank balance of a limited company was 390,000 before the following transactions took place. We need to figure out the bank balance after these transactions. The first one is an issue of 500,000 new shares of 0.50 each, made at a premium of 0.52 per share, which means that the shares were issued at 0.50 plus 0.25, which is 0.75. Alright, now the total value of the shared issues is going to be 500,000 into the rate in which the shares were issued, which is 0.75. So the total value is going to be 375,000. So this increases the value in the bank balance. So I'm just going to add it, 390,000 plus 375,000. Alright, the second one is debenture of 100,000 was repaid. This deducts the balance on the bank account. So that's going to be reduced. The last one is a bonus issue. So bonus issue does not result in any cash inflow or outflow, which means that this is not going to change the balance on the bank account. So this is our total. That's going to be 390,000 plus 375,000 minus 100,000, which gives the value of 665,000. That's going to be the bank balance after all of those above mentioned transactions, which is given in option B. What might cause a decrease in a company's non-current asset turnover? So non-current asset turnover is given by sales divided by the value of non-current assets. So if the value of the non-current asset turnover is to be decreased, then either the sales have to decrease or the value of non-current assets need to be increased. Alright, we're looking for these two. The first one is increase in expenses. Any changes in expenses does not result in any change in the non-current asset turnover, so this is incorrect. The second one we have is increase in sales revenue. But as we've mentioned before, we need a decrease in the sales revenue, so that's going to be incorrect as well. The third one is purchase of new non-current assets. So if we purchase a new non-current asset, then the value of non-current asset is bound to be increased. So that's what we're looking for. So option C is correct. Option D is selling non-current assets. So while selling non-current assets, the value for the non-current asset will decrease, which is not what we're looking for. So option D is incorrect as well, which means that the correct answer is option C. The following information for a limited company at 31st December 2021 is available. We're given the ordinary share capital, retained earnings at 8% debenture. Now, retained earnings at 1st January 2021 is given, and then an interim dividend was also paid. We need to figure out the return on capital employed. So return on capital employed is just going to be profit before interest and tax divided by capital employed into 100%. So in order to figure out the profit before interest and tax, we need to figure out profit for the year. And in order to figure out profit for the year, I'm just going to create the schedule for retained earnings, because we're given the opening value as well as the closing value and the amount for the interim dividend. So the opening value is going to be 82,000, and we gave out a dividend of 45,000, so that's going to be deducted, and profit for the year is added. That gives us the closing balance of 110,000. Now the profit here acts as a balancing figure, and in order to figure this out, I need to deduct these two values from the total value. That's going to be 110,000 minus 82,000 plus 45,000, which gives us the profit for the year of 73,000. But we need to figure out profit before interest and tax, which means that the interest amount need to be added to the 73,000. And we know that interest is paid on the debenture and the interest rate is 8%. So let's just figure out the interest first. That's going to be 100,000 into 8%. That's going to be 8,000. So the profit before interest and tax is going to be 73,000 plus 8,000. That is 81,000. All right, now we're going to figure out the capital employed. So capital employed includes the ordinary share capital, that's 300,000. It also includes the retained earnings, that's 110,000. And it also includes the debenture, so that's another 100,000, which gives us the total of 510,000. All right, we have all the values that we require, so that's going to be 81,000 divided by 510,000 into 100%, which gives us the return on capital employed of 15.88%, which is given in option D. Which statements about step costs are correct? The first one is fixed within a range of activity levels. So stepped cost is going to be something like this, which means that the value is fixed for this certain range, and then again the value is increased for this certain range of production, and the value is increased for this certain range of production. So fixed within a range of activity levels, that is true. The second one is fixed whatever the level of activity. So if it were to be fixed whatever the level of activity, the graph would have been something like this, which is not equal to this graph. So this is incorrect. The third one is include fixed costs only. This is correct because step cost only includes the fixed costs. And the fourth one is includes both fixed and variable costs. That's incorrect. So the correct answer is going to be option A. A production worker is paid 15 per hour for working 8 hours a day. So that's the basic rate. And then overtime is paid at the rate of time and a fifth. So the overtime rate is going to be basic plus 20%, which is 15 into 1.20. That's 18 per hour. A productivity bonus is also paid at the rate of 21. So this is bonus per unit for each unit produced in excess of 12 units per day. Last Friday, the production worker worked 12 hours and assembled 14 units. We need to figure out how much did he earn on that day. So for 8 hours, he's going to get the basic rate of 15. And for the remaining 4 hours, because that's the difference between 12 and 8. For the remaining 4 hours, he's going to get the overtime rate of 18. And he assembled 14 units, which is 2 more than 12 units. So he's going to also get the bonus for 2 units, which is 21 into 2. So that's the total amount of 234, which is given in option D. A retailer made the following purchases of inventory in October. So that's 3 purchases. We're given that there was no opening inventory, and the business uses the FIFO method to value its inventory. So whichever inventory was purchased first, that's going to be sold first. And in October, 200 units were sold for 900 each. We need to figure out the gross profit. So gross profit is given by sales minus cost of goods sold. All right, sales value. Let's just figure that out first. So we're given that 200 units were sold for 900 each. That's going to be 200 into 900, which gives the total value of 180,000. Now for the cost of goods sold, the formula is going to be opening inventory plus purchase minus closing inventory. And we're given that there was no opening inventory, so that's going to be 0. And the total purchase amount is going to be this. That's 128,750 minus closing inventory. So closing inventory are the cost of those goods that were not sold. So we're given that 200 units were sold. So the first purchase 50, that is sold, and the second purchase of 50 units, that's sold as well. Now for the third purchase, 100 units out of 150 were sold, which means that 50 units still remain in the company. So that's going to be the closing inventory. So for 50 units, the total cost is going to be 50 into 525, which gives the closing inventory of 26,250. So that's going to be included here as well, which gives the total cost of goods sold at 102,500. So we need to deduct this value from the sales. Now this gives us the gross profit of 77,500, which is given in option C. A company has 2 departments in its factory, and we're given the following details. We're given the budgeted fixed overheads and budgeted hours for both the machining and assembly department. Alright, we need to figure out the fixed overhead absorption rate per hour in the machining department, which means that we can completely ignore the assembly department. And in order to figure out the fixed overhead absorption rate, that's going to be budgeted fixed overheads divided by budgeted hours. So since we're only talking about the machining department, we're going to include the value of 180,000 and 6,000. So that's going to be 180,000 divided by 6,000, which gives us the fixed overhead absorption rate of $30, which is given in option C. What would cause overheads to be overabsorbed? So we're talking about overheads, and we know that they're going to be overabsorbed only when the budgeted overhead is greater than the actual overheads. Alright, we're looking for this. The first one is overhead absorbed. So we're not talking about overhead absorbed. So this is going to be the budgeted overhead and the actual overhead incurred. So we can conclude that option A and option B are incorrect. And the third option is that the overhead incurred is greater than the overhead absorbed. That's actually the opposite. We're looking at overhead incurred is less than overhead absorbed, which is given in option D. So the correct answer is going to be option D. A company has the following information for producing 2,000 units of a product. We're given the sales revenue, all the direct costs, and the fixed costs. And we need to figure out the contribution to sales ratio. In order to figure out this, we need to divide the contribution by sales and multiply it with 100. Alright, so we already have the sales value, but we need to figure out the contribution. And we know that contribution is equal to sales minus variable cost. So let's just figure out the variable cost first. So variable cost includes all of the direct costs. So that's going to be direct materials of 30,000 plus direct labor of 14,000 plus direct expenses of 2,500 plus other variable overheads. So that's going to be 10,200. So this gives the total variable cost of 56,700. Alright, we can easily figure out the contribution now. That's going to be 85,000 minus 56,700, which gives the contribution of 28,300. Alright, so we're just going to substitute the values. That's going to be 85,000 into 100%. So this gives the contribution to sales ratio of 33.29%, which is given in option B. The following information is available about 2 products. We're given product 1 and product 2. and we're given the material X, material Y, and direct labor that is required to produce both the product 1 and product 2. That's per unit. Alright, then the production is planned to be 100 units of each product. So that's going to be 100 units of product 1 and 100 units of product 2. Then 700 kilos of material X, 400 kilos of material Y are available, and a total of 800 direct labor hours can be worked. So we need to figure out the limiting factors. In order to figure that out, we need to figure out the actual material X, material Y, and direct labor required to produce 100 units of both product 1 and product 2. Alright, I'm going to calculate the material X first. So for product 1, that's 2 into 100. And for product 2, that's going to be 4 into 100, which gives a total of 600 kilos, which is lesser than the available 700 kilos, which means that material X is not a limiting factor. Alright, the second one, I'm going to calculate for material Y. That's going to be 3 into 100 plus 1 into 100. So that's 400 kilos. So this is exactly the amount of material Y which is available, which means that material Y is also not a limiting factor. The last one we have is direct labor. So that's going to be 3 into 100 plus 6 into 100, which is 900 hours. And the total direct labor hour available is only 800, which means that the available direct labor hours is less than what we actually require. This suggests that the limiting factor is only going to be the direct labor hour, which is given in option A. A company provides the following information about its product. We're given the selling price, variable cost per unit, fixed cost, and the break-even point. Now, the business changes its production method, then the contribution will increase by 10% and the fixed cost will increase by 5%. Alright, let's just increase these values first. So the previous contribution is going to be the difference. That's 100 minus 40, which is 60. But now the contribution will increase by 10%. So the changed contribution is going to be 60 into 1.10, which is 66. And then the fixed cost will also increase by 5%. So that's going to be 21,600 into 1.05, which is going to be 22,680. Now the new break-even point is going to be the fixed cost, which is 22,680 divided by contribution per unit, which is 66. That's going to be 343.64, and that can be rounded off to 344. So now we need to figure out the effect, which means we need to figure out the change. So previously it was 360 units. Currently that's going to be 344 units, which means that the break-even point has definitely decreased. By how much? So that's just going to be the difference. So that's 360 minus 344, which is 16. So 16 units has decreased, which is given by option A. What are possible limitations of a budgetary control system? The first one is that the budgets are based on estimates. That's correct. That can be a limitation. The second one is that the budgets may lead to staff demotivation. So budget is something that's going to set the goals for the entire workforce, right? And sometimes the goal can actually act as an overload for the workers and they might lose motivation to properly do their job. So that's going to be correct as well. And the third one is that the budgets may prevent managers from being creative. That's true as well, because budget kind of constricts the managers to work in a certain direction to head for a certain goal. So that's definitely preventing them from being creative. So our correct answer is going to be option C. That brings us to the end of this set. If you found this video useful, make sure you leave a like, leave a comment, and make sure to subscribe and hit the bell icon if you want to view more of these contents in the future. Thank you.